Welcome back to this Indianomics, where we've been discussing the emerging contours of the global economy in the light of the lower than expected US inflation numbers and a fairly serious disinflation one is seeing in China, as evinced by the trade data that was announced over the last 24 hours. I've been speaking with Jahangir Aziz of JPMorgan, Robert Sockin of Citi, and Aditya Bhave of Bank of America. Gentlemen, thank you very much for your patience. Well, Aditya, the question before I went to the break was that are we in for a Goldilocks scenario for at least the next 12 months before perhaps recession fears hit us?
I would say based on the recent data flow, for sure, the risks of a Goldilocks scenario have increased. Our baseline forecast is still very benign. It does have a recession in it in the first half of next year, but it's very, very mild by historical standards. We have about a 0.4% contraction in GDP from peak to trough. So whether we get that or we get an actual kind of no landing scenario, I think both of those would be fairly Goldilocks. I would guard against complacency, though. Going back to the old saying, monetary policy works with long and variable lags. If you think back to 2008-09, the Fed stopped hiking in 2006, and the recession didn't start until January of 2008. The financial crisis didn't really kick in until later that year. So I don't think we're out of the woods yet. There's signs of significant credit tightening across business and consumers. I would keep an eye on that. But based on the recent data flow, based on the disinflation that we're getting, the benign so far slowdown in payrolls, yes, the risks of a Goldilocks outcome have increased. And that's what's being reflected in market pricing as well.
Robert, would you bet on this Goldilocks falling core inflation and resilient growth, at least for the next probably year or more?
Yeah, and I completely agree that it's hard to say with the data stream that we've gotten in recent weeks that the probability of softer landing Goldilocks type scenarios have gone up. But I do agree that it does require a fair amount of caution. And I still think it's fairly far from being the base case. And the reason being, and there's a couple things to highlight. One being, of course, as we've all noted, we've had some good inflation data come out for the US, but the Fed has been head faked before by the inflation data, and inflation is a very noisy process, particularly month over month, especially in a lot of these type of smaller services type categories. There can be a lot of volatility and noise that's hard to predict. So I do think, to just point to a few inflation prints and think that inflation is going to continue to cool rapidly. I think, it's too soon to say that based on the data. Then also based on the fundamentals, I think there's a lot of reason to be concerned that inflation is going to remain very persistent.
Jahangir, India is less affected by the kind of services inflation and perhaps even goods inflation that Robert is talking about that's bedeviling the US. We are more likely to be impacted, like the inflation numbers, our own June inflation numbers showed us, even if there were tomato-led food inflation, core inflation fell, and that's partly because of what you are saying. Chinese imports into India, or even chemicals imports from anywhere in Asia, have really capitulated in terms of prices. So do you think a country like India emerges as the winner on many accounts? One, that exports will not fall so much because the West is not really collapsing. Two, core inflation is not going to be too bad. And three, we're not going to even have a currency problem going the way dollar is headed. Good spot for India, you think?
So I think, for all emerging markets, including India, I think key to whether or not we have rate hikes in the Fed and whether or not emerging market can cut while the Fed is raising rates, and emerging markets did cut while the Fed was raising rate back in 2017-18, when Janet Yellen took rates up by 275 basis points, the key remains the dollar. So if the dollar remains benign or does not have a disruptive appreciation because of whatever happens, whether it's more rate hikes in the US or US goes into recession and brings the world into global recession, as long as the dollar remains benign, which it has, and surprisingly so, in the last 2 months, you've seen the 2-year US basically rise about 125 basis points, and nothing happened to the dollar. But as long as the dollar remains benign, I think emerging markets will be able to get through both with rate hikes, even while the Fed is rate cuts, even while the Fed is raising rates, or is on a long hold. And I think that is probably the strength for emerging market efforts. I think the part about growth and the part about whether or not emerging markets will be able to deliver strong growth. I think all three of us are talking about resilience. You're talking about resilience, but when we talk about resilience, we don't really mean that yesterday's growth will be sustained. Okay. We actually need, and we actually have in all our forecasts, I'm sure that all the other Robert and Aditya will agree, is that there is a significant slowdown in the global economy that will have to take place and is in our forecast in the next 2 and 3 quarters. So resilience does not mean the growth is not going to slow down. In the case of emerging market, that is what is going to happen. In the case of India, that is also going to happen if the global economy slows down. Okay. So this is not about growth not slowing down. Okay. It is about growth not slowing down and getting us into a recession. That's the resilience part of it. So I think we need to interpret the term resilience carefully, rather than basically interpret it as saying, because we are saying that if the global economy is going to be resilient, means that yesterday's growth numbers are going to be repeated. Yesterday's growth numbers will not be repeated.
Got that.
We need the economy to slow down, the global economy to slow down if we have.
And that's what central bankers are working towards.
That's right.
I take your point. I take your point that I'm sorry I'm rushing you, Jahangir, because we are out of time and I can't allow Aditya and Robert to nuance what you just said. But it does look like there seems to be some agreement that it's not a hard recession, but let's be prepared for some slowdown. Thank you very much for joining me on this very special edition of Indianomics.